Scale is the blockchain that's truly built different. Forget gas fees and waiting. Scale offers a seamless Web3 experience with fast, fee free transactions. Whether it's gaming, AI, or next gen dApps, Scale is here to power your future. Explore more at scale.space/ecosystem and follow them on X at Scale Network. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. This holiday season, upgrade to the latest in secure digital ownership with Ledger Flex and get $70 in Bitcoin. Ledger Flex combines uncompromising security with the ease of the world's first secure touchscreen wallet, simplifying your transactions and protecting your digital assets with Ledger's secure chip and proprietary OS. Don't miss this special offer, valid from December 16th to 23rd while supplies last. Celebrate the holidays with the most trusted name in hardware wallets. Visit ledger.com today. Meet Kraken Institutional. Whether you're an asset allocator, a trading firm, or high net worth individual, Kraken Institutional unlocks the powerful tools you and your organization need to trade and manage crypto at scale. Reliable, easy to integrate, with white glove service and 24/7 support. Visit kraken.com/institutions and get in touch today. This is not investment advice. Crypto trading involves risk of loss and is offered to U.S. customers through Payword Interactive Inc. View legal disclosures at kraken.com/legal/disclosures. Welcome back to another Roundup edition of Forward Guidance. And we are four people today. Managed to wrangle in Danny Dan, who is I really wanted to get him on this week because there's a lot that happened in markets. This weird combination of obviously the macro side of things, but also some really interesting positioning dynamics, vol dynamics that just really want to spend the first half of the show here to unpack. So we've got Danny here today who's going to join us, join in on the roundtable, chat it up, and give some of his updated views because, I want to give you props that when I think it was September, you wrote a Substack piece and you called it flip flop. And the main premise was just that, the Fed just has no real idea of what they're doing here. They have no idea where the neutral rate is, and they're just going to be flip flopping every other meeting. And that's proving pretty prescient. So it's great to have you on, Danny.
Thanks for having me on. Yeah, first of all, thanks to be on the new show. Really happy to see what you've been doing with it. Yeah, my flip flop thesis is they're basically making it up as they go. The metrics that they basically put out there that they're looking at, if they go the opposite direction they like, they kind of ignore them. They kind of point to other things. Unfortunately, they're making it up as we go. I think Wednesday was potentially a step in the right direction, although we'll see, from there.
Yeah, I'm interested to hear everybody's thoughts on whether it was the right direction or the wrong direction. I feel like I'm still a bit more 50-50. But yeah, maybe we'll start with you, Danny, just super quick on why you think it was the right direction overall.
Yeah, look, the fact is inflation is sticky, and it doesn't mean that we have a second wave on our hands. But first of all, growth is exceptionally strong, right? GDP is tracking over 3% another quarter. We just got Q3 official, updated revision as of yesterday. It was 3.1. We're tracking over 3. So the economy is really strong. Okay. There are some concerns about the labor market that people have out there. I'm not, I'm also paying attention to certain dynamics of the labor market. Overall, I think it's strong and has upside. We've had 4 straight core CPIs of 0.3% month over month, 8 of 11 this year, 0.3 month over month. We had early year couple prints that were higher. We had in the summer seasonal period, some prints that were lower. These tend to be seasonal movements, but overall we're trending 0.3, which is a 3.6 pace. If you actually averaged the 2023 prints, it was 0.3. We have made no progress on inflation this year. And 4 straight prints plus the really strong growth profile. And then, last but not least, there is some optimism building for this Trump agenda. It hasn't played out yet. We haven't, he hasn't implemented his agenda. It's all, optimism and surveys and that so far, not in the hard data. But there is some serious optimism in parts of the economy that has been, frankly, left behind for 2 years, that has been dormant for 2 years. And so I think what the Fed, basically did is they weren't hawkish. Okay, you don't cut rates if you're hawkish. And you don't have in your dot plot 0 probability of hikes if you're hawkish. But what they did was sort of tilt from growth back to inflation. And the reason I say that they did the right thing is I don't think they should have cut this week. It doesn't really make sense, even with what they're saying and what they're doing, to cut this week. I believe neutral is 4.5. So I think they may have even gone below neutral, although by an inch, not a huge deal. But they did adjustment cuts to support growth. Remember, we have a 4.2% unemployment rate, 4.25 if you round it, to the decimal. But 4.25 is still closer to overheat than it is to recession. Okay, 5.5 is far closer to recession than it is to overheat. So when you have that dynamic, you don't want to overdo it. And adjustment cuts, they did. Now they have a chance to sit back and look at the data. They think being on hold will be enough to finish the job on inflation. We'll see. I think the Trump agenda is potentially inflationary, at least in the early, part of it. And so, we'll have to see how it plays out. But I think they reset the narrative a little bit. And, frankly, the bond market was priced for this. SOFR December 25 print was pretty close to their dot, of where they had 25, policy rates. But it was just equities that were, over their skis in sentiment, positioning, leverage, volatility dynamics. And so that was the reaction that was, much larger.
Tyler, Quinn, is there anything you guys wanted to add in there, ask Danny further, double click on there?
First thing I want to say is he's bringing up our outfits by like a scale of 10, wearing that crisp. Look at that crisp shirt. Wow. We usually look like bums on here. He looks great.
It's Friday morning.
I'm going to disagree with him. First thing, love having you on, Danny. But I will say, I think inflation's rolling over here, and I think it's actually going to go lower. Just because, not for, I agree it's been stickier, but I think geopolitically, like China's slowing way faster than we think it is, which, globally, I think that's going to be a massively disinflationary pressure. And like, we can get into some of the Chinese interest rate charts later, but they're in a huge balance sheet recession. Their 2-year yields are falling, 10-year yields are falling there, and I think it's going to be tricky because we live in this globalized world now. The one thing I will say is like housing CPI data is probably going to be stickier, just because that's the one thing you guys could probably speak to better than I. But in terms of commodity inflation with China rolling, I'm kind of in the camp of we're actually on a disinflationary environment, and the higher interest rates go, the more it kind of like squeezes. It's like a global margin call in emerging markets. So that's sort of where I'm at.
I'm more in the middle and probably slightly lean with Danny. I think I expect China to come out with more stimulus, and I expect it to sort of be enough. Like, I'm looking at like some of these Chinese equity charts. That is sort of worst nightmare. Sorry?
I will say, you're right. I think the fact that FXI is up today is kind of nuts.
It's been extremely resilient. For the talk of like disinflation in commodity land, I mean, we're supposed to have just gone through the worst economic growth scare in like 2 years over the last 6 months, and stout at 67, $70, whatever. So the worst nightmare, I think, for the Fed here, because we all know what part of inflation has brought the headline number down as goods, is if there is a big stimulus on the Chinese front, which in my opinion could actually bolster the Asian currencies and weaken the dollar. And then that's kind of doubly inflationary in the US if you have a weaker dollar plus higher commodities. Not that I don't really see an impetus, right? 2022 was a war, there's all these geopolitical events. Like, doesn't mean commodity oil is going to go to 100, but I agree with your point, Stanley, on I've been calling it like the stop start liquidity environment, where it's just so strange how I get it, right? They've done 100 basis points cuts now, and they're focusing on the inflation side of the mandate, which makes sense. But just the demeanor, Powell was like shaking. Like, when he came out, I was like, this is weird. Like, was it a 10th FOMC? I mean, and then you see 4 people actually penciled in no cut this week. That was the most hawkish thing to me, was like, oh, wow. So 4 people, I would have expected them all to just kind of roll over and say, well, the market thinks there's a 98% chance of a cut. I'm not putting a cut because like we would never do it. And it was like, oh, that's interesting. So, I mean, January pause is a given. I do think we're in this weird spot where like in a normal world, growth might become a bigger concern, but you have this Trump optimism, you have that small business survey bump. And yeah, I kind of agree. I think it was basically Powell and Fed's way of like saying 3% is the new 2. Like there's no, like they were quote unquote more hawkish. They raised the neutral rate, and he really, it was a lot of jawboning, because the second we get a 4.3, 4.4, 4.5 on the unemployment, they're going to be back to like working in cut language again. And maybe you get another August type event at some point next year before all the, pro business Trump things kick in. But like, yeah, inflation, I kind of think inflation's here. I see it bottoming in my opinion. And I also see that and think like the Fed's always going to support growth. So that's sort of what people are figuring out here. And you're seeing with macro people, more and more non-crypto people are talking about Bitcoin for this reason. They're like, all right, if the Fed has seen 3, 4 now back to back, like 2.5 to 3% prints with no improvement, like they're sending a message here. Like whatever they say, they're sending a message because in their actions. And that's like, we're just going to need inflation to be here.
Yeah, I mean, I think, good, like on the inflation side, we have already had the goods deflation, and we've had pretty extreme goods deflation. So, from that standpoint, I think there's only upside, and I think shelter has 16 to 20 months left at the run rate it's been running at before it catches up to, real-time rents. And so, from that standpoint, I think the issue that people are facing with the Trump agenda, in my opinion, or the mistake they're making, is understanding the sequence. So when he comes in, I think one of the first things they're going to do is bank deregulation, which is going to stimulate the economy via lending. We've had 2 years straight of close to 6% nominal GDP, although a step down in the last 2 quarters, with no credit expansion, right? And that is a big driver of small businesses, is they don't have the ability to issue investment grade bonds or high yield bonds in the market. They have to borrow from banks. And the regional banks, frankly, not because policy was restrictive, because of the regional bank crisis last year, have been slowly repairing their balance sheets, and lending standards have been slowly easing. And so I think that is a huge impulse for positive for the economy. That's where I think the impulse comes from. Secondly, he's going to do tariffs right away. Now, tariffs in the grand scheme of things don't have to be inflationary, long term, but that's not going to be day one. Day one is going to be, we're putting on tariffs. Tariffs will be inflationary. And so the concern is that we get a 4% CPI, level. I don't think the Fed can ignore that. If the economy is also on an upswing, growth from lending or whatever, optimism, even if it's short-lived, if goods economy, manufacturing has some upside, which we've seen some potential early inflections there. Housing is shown to be a little bit more resilient at higher rates than we previously have seen in the last 2 years. So some of these dynamics to me have changed. And so I think that we've had a paradigm shift, in particular since the FOMC, but more from the election. And I think that's where markets are a bit off, is still expecting the dynamics of the last 2 years to play out. That's no longer my framework. Even though I focus on financial conditions a lot, I do think we've had a paradigm shift, and I think it'll take time for people to figure that out.
Danny, what do you make of the market structure, systematic vol spike we just saw in the light? It feels like we're all on the same page in terms of like growth is pretty good in the US and it's kind of sucking dollars in. We're sucking currency in from all over the world. But like, what was that? Can you explain it?
It's a perfect storm, really. I mean, you have, positioning all-time highs. You have sentiment all-time highs. You had the VIX at 13 to 15. And in particular, you had correlations, between individual companies, down back at zero, where it was as close to zero as it gets. where it was before the August, meltdown. So you kind of had the perfect storm. But I think really there's been this narrative out there, and you guys mentioned it, where 3% is the new 2%. The Fed doesn't care about inflation. They're just going to keep cutting, 10 times or, 200 bips in a year when the economy is strong. And we have animal spirits in the markets as a result of that, at a time when we have growth optimism, in my opinion, picking up substantially. So you just had a little bit offsides, in terms of positioning and everything there. You also had, frankly, an expectation. Almost everyone had this view, and even me, that you're going to get the Santa rally. And then you're going to get January 1, people take, a sell off anything that they need to realize taxes, that they just didn't want to do at the end of the year. So we get a little bit of a bump at the beginning of Q1, and it got thrown into a window. And I think, that for anyone who stayed long, I'm really thinking institutional investors now, hedge funds. It's important to understand hedge funds operate differently than retail guys. If you buy a stock and it, is up 50% for you since your purchase, and you go to the end of December, the last 10 days, and it goes 10% against you, but you plan on holding it, no big deal, right? Like you're not going to like reshuffle your life on it. But for a hedge fund, December 31st is all that matters. It matters for what the P&L is for investors, for their statements. It matters for fee collection calculation, and it matters for bonus calculation. So I think in what I'm curious about, and I tweeted this yesterday, is, we had a relief rally in the morning. I expected that to fall apart as institutional investors look at the situation and say, do I want to either pay up for a big expensive VIX hedge, or volatility hedge, put spreads or whatever it is when VIX is 23, 25, 26, or do I want to just take chips off the table, lock in my year? And so I think there's some of that. Today, my VIX indicator, though, flagged that the VIX episode is over. So, I think that was notable, and the VIX has fallen a few points this morning.
Yeah, because Tyler, you're saying you mostly look at the term structure, right, of VIX, and just like whether it's in contango, backward. Is that similar to what you look at, Danny?
No, I do look at the term structure, and that's a sign of stress. I look at VVIX relative to VIX. So VVIX relative to VIX, VVIX is basically, for those that don't know, the volatility of the VIX index. And so what drives VVIX is flows on VIX options, right? So if people are buying a ton of VIX options, VVIX will actually go up before the VIX will. So when you see VVIX, VIX moving sharply higher, and then it peaks, that's when you expect the VIX to catch up. So people bought VIX calls. We're now positioned where dealers will be short VIX calls and have to hedge that in the event that something happens. Doesn't have to happen, but if something happens, which it did on Wednesday, then the VIX catches up to where the VVIX is. And then today, the relationship bottomed. You had like a cathartic blow off bottom in this relationship, which is the opposite, which means now VIX should come down. VIX is too elevated relative to VVIX. And so now VIX will start to relax. So where I don't know, and I'm going to be clear here, look, I bought the dip this morning. I thought, things had got a little too extreme, and we had a favorable eco print, this morning. I bought the dip, but it's a short dated thing, and it's like a 3 of 10 positioning. But what I had higher conviction on is the VIX is done. And so we're not going to 12. We're not going back there. But I think, 18, 16 is probably where we go. And so even if institutional investors say, I still want to de-risk for year end, and it's rational for them to think that way because, you have 10 days of low volume trading, anything can happen, and you're just very concerned about your year end P&L. If they do, I think it'll be rally, we get a rally and then they VWAP sell. It won't be a volatile sell. It'll be a grind lower sell. So, I would just say for most people who are super excited, maybe this is day trading environment for the next 10 days, and then you get ready with your big bullets for the beginning of the year. rather than get over your skis here in what could be totally erratic and out of like you won't know what's driving the market in the next 10 days. That's kind of how I see it.
Maybe Felix, you want to go to that? My 2 slides. I just think it's while we're on the Fed topic, maybe it's a good place to wrap it up and transition into the market stuff. But I put, I like how I always make fun of Tyler of like, chart good, I buy. My favorite like stupid simple KISS method charts to create are these efficient frontiers. And I wrote this in my.
This is my favorite Quinn Thompson. He rags on me for being the dumbass of the world, and he posts a chart like this, which is also brilliant, by the way. If you
but this is I put this in my letter, and I said, if you're long, if you're long S&P Mag 7 at 2021 price to earnings forward and trailing price to earnings into this, and levered, and everybody, we've seen all the positioning things. Just know the best is behind, right? If we're saying valuations are very extended, that's not a market timing tool, obviously. But what are extended valuations supported by? Its liquidity. And we basically just had 100 bips in cuts in 4 months, and we might get 2 all of next year. Maybe we get 3 if things deteriorate. But basically, the really, really supportive environment's behind us. And now you move into either higher inflation or slower growth or just less liquidity relative. And then the next one is just the kind of chart form of that, which quantifies that for people. So it's like, we just got the Fed funds rate accommodation in green, which is the rate, and then red is inflation. And basically the difference, we basically got, the same Fed funds rate accommodation in the last 4 months that we might get in the next 2 years. I mean, obviously if something breaks, then you're going to get more. But so that's how I view it. And actually, Danny, one of the things I've noticed is like the rotational aspects of this market. And there's, to me, watching the tape every day, been some hiding out. There's been some things that just Mag 7 really have not moved. And then you have these cyclicals, right? Which home builders, energy, banks, which small caps, value, which also almost all happen to be quote unquote Trump trades. At least from a relative performance, right? You don't have to take a view that the beta is going to go up for these things to outperform, big tech. And I find it really interesting that those things continue to get sold down really, really hard in this unwind. And it's not surprising. We had options expiration this week. There's funky things around the index being pinned and the constituents kind of offsetting that. But it sets up for a really unique opportunity, in my opinion, going into the new year and the inauguration, because a lot of this stuff, like you said, there's real reason to be optimistic. If you just look at his past presidency, right? Oil was up the whole time until COVID. The price of oil, we had a stronger than expected economy. Financial deregulation is coming, like not just crypto going wild. No one hates the SEC more than Elon. And we're going to de facto not have an SEC for 4 years. Good for regionals and value too. Home builders, Main Street economy. And then he's got an FCC chair and the whole administration who's quote unquote said their duty is to rein in big tech. So I find this divergence in what the market positioning has done over this last bit of sell-off with what my personal go forward, the industries and sectors I'm really excited about. And it, last thing to put a pin in it, reminds me of 2022. If you remember, in 2022, obviously was this inflationary value year. Tech got smoked. But in October, beta pretty much bottomed. It was the big pivot from global central banks and fiscal leaders. They weakened the dollar. We had the BOE gilt scare. That was the pivotal change. But tech and all the stuff that got sold throughout the year continued to really suck wind, particularly the last 2 weeks of December into year end, despite a very shifting macro tailwind into what we saw was a massive, maybe short squeeze in January, or just that rotation as people didn't want to sell their winners in year end and rotate into the things that would perform going forward. So that's what I think is really interesting. I wouldn't be surprised to see the things that have been leading over the last few weeks really suck wind going into the first quarter. And to me, less of a super strong view near term if that means market up or market down. But it seems to me like we're at max relative performance given where the macro is and the underlying kind of growth inflation drivers for a lot of these like Meg 7 safety versus cyclical type of ratios.
I'll provide some, possible counter arguments, although I'm going to say I'm a little bit uncertain on this. About 10 days ago, I wrote to clients a derotation note, basically saying the RTY, small cap outperformance, cyclical outperformance was done. And the reason I said that is, the run up in these since the election is reflecting optimism, like we talked about, surveys. It's going to take at least 2 quarters for this to show up in earnings. So even if the Trump agenda is implemented as expected, the dereg agenda will be at some point in the middle of Q1, right? So you're looking at, possibly Q2, Q3, where this really is effective. So I'm a little bit more cautious in that, but I do think as we get into the Trump economy, that there's a lot of catch up for cyclicals and small caps relative to the tech. I don't think it's going to be a tech only rally. I think it's going to change, but I would just be a little bit more cautious about saying I'm going to jump on this on Jan 1. And I think that's because the multiple expansion since the election is pretty large in, let's say, the Russell 2000, but on the Qs, multiples haven't expanded; they've gone sideways. So that, to me, is rational to say that we may still get the tech outperformance, but I do think if you have a longer horizon, the cyclicals will outperform. Housing, I'm a little bit mixed. I'm 50-50 on how it's going to play out. I see both arguments out there. I'm not really sure, but yeah, that's how I would see the cyclical story, of it as it plays out in the beginning of the year.
To play ping pong, I'm gonna go balls long IWM here. I think we just made a huge low. Can I run through some of these charts?
Yeah, do it.
The NFL.
I agree. Like there's a lot of dispersion. Is I guess my main point is like I think it's gonna be a great stock pickers market.
It will. It will. Yeah, absolutely.
Yeah, I'm with you on housing. I think with rates, being stubborn here, mortgage rates being stubborn, that's not necessarily I'm super bullish on, but like relative, I think we saw like a blow off top, like we talked about last week, and some of the Mag 7 stuff. I'm just going to do a recap of what went on. So let's go to slide 22. I talked about this kind of on Twitter this week, but this is the 2-year yield versus the 2-year break evens. And what we saw was, the Fed targeted inflation, break evens went lower, and then the 2-year nominal went higher. So we saw that spike. Now that's coming down as, I think the market repriced the hawkish expectations way too hard. It was pretty much down the middle, but like all these systematic morons just, absolutely pound things in either direction. And then go to slide 23. This is the VIX inversion, not the VVIX. That's a good one. I got to put on my radar, Danny. But this is the VIX front month versus the 3 month. When the front month VIX is more expensive than the 3 months out, it's been the best indicator ever.
Yep.
For buying equity. So, and then go to the next one. This is from our boys at Piper. This is slide 24. Look at how steep the VIX curve got in 2 days. Like everyone raced to buy downside protection in an illiquid market. Mostly systematic investors, these vol targeting funds, they really pervert things. And there's 2 or 3 days during the quarter where they absolutely annihilate. And it's this self-reinforcing thing where VIX goes up, de-lever. It's like, talk about me being a dumbass. Like all these programmatic things is like VIX up, sell stock, VIX up, sell stock. And then you have the dynamic of like retail was balls long calls. So basically what happens is just the dynamic of what was positioning wise. You had retail really long calls, right? When you buy a call, the street sells you the call and then they go hedge the delta of that call by buying stock, right? And so what happens when the stock goes against you as a retail buyer, you wake up and you're your call is down by say 20%, you sell that call, but then on the opposite side, the dealer that sold you that call essentially has to sell stock, the stock they were delta hedging. So it creates this self-reinforcing downside pressure. So a lot of these like real quick, sharp moves are self-reinforcing in either direction. You never really know when they're going to stop. And I think that's part of the problem with just all this systematic quant stuff. But look at, here's some capitulation stuff for you. Slide 26. This is from John Krinsky at BTIG. Less than 8% of the S&P is above its 20-day moving average, which is exactly like signs of exhaustion. And then slide 27, this is, this is the VIX inversion. You can just see it over a longer time horizon. When the VIX inverts, it's always a great buy for equity. And then the next thing is just, this is from Goldman, good quote. We saw 100 percentile short selling. In cumulative notional terms, the short selling in U.S. equities over the past 4 sessions is the largest since January and ranks in the 100th percentile on a 5-year look back. So systematic investors, bang, VIX spikes, sell the shit out of everything. And now we're seeing it roll off here because the VIX got so pushed up. And here's where the technicals get really interesting. Slide 29, Bitcoin. Perfect retest of the 50-day moving average. Bounced off it perfectly. And it's even up even more. It's at 97,300 right now. And then check out the Goldman Sachs Momo basket. Like these are all like, this is how stupid systematic investing is. The next chart is the Goldman Sachs Momo basket. This is actually looking better. So the MACD is crossing the upside and hit the 250-day. It's like the market is healing. Now, this is the one part of the market I'm going to stop my slideshow that I'm a little nervous about is slide 31. This is the Asia dollar index that we talked about last week. And China is the hardest thing in the market to figure out. They're going through like this giant real estate delevering. They're getting annihilated. So the China dollar broke the support of 90. Does that cause a credit stress in the US? It did for a couple of days this week, which makes me a little bit nervous. This is why I'm not like super, like I'm bulled up on this dip, but like if things go lower, there's definitely something globally that's really fishy. And then if you go to like the next one, this is the China 2-year yield. It's at 1.08. So there's something funky going on in China. The weird part, like Quinn mentioned before, is the Chinese equity markets are actually not crumbling. So I don't know what to make of that. It's really crazy.
Yeah.
But it's something that we should all be paying close attention to, because if there is some sort of global credit unwind here, we're going to be watching like high yield credit spreads a lot in the US. We're going to be watching, if that kicks up, then you probably want to just de-risk. But right now, the way, seasonality, how ridiculous the VIX got, this feels very bullish to me into January. Like we cleansed the market. And also I want to ask you guys, like, can you explain perpetuals to like, non-degens? Because this is another part of the market that I think the TradFi system is not aware of in crypto, specifically of how you can get 20x leverage. Say you put $1,000 up, you get 20x leverage, and then you get stomped out. And that's what creates these crazy drawdowns in the middle of the night.
Scale is shaking up the blockchain game. With a gas-free, invisible experience, it's the perfect solution for developers and users alike. Forget unpredictable fees. Scale's innovative model ensures smooth, cost-free transactions, saving users over $9 billion so far. With over 46 million active wallets, Scale is proving itself as the go-to blockchain for gaming, AI, and more. Explore the Scale ecosystem at skale.space/ecosystem and follow their journey on X at Scale Network. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. This holiday season, upgrade to the latest in secure digital ownership with Ledger Flex and get $70 in Bitcoin. Ledger Flex combines uncompromising security with the ease of the world's first secure touchscreen wallet, simplifying your transactions and protecting your digital assets with Ledger's secure chip and proprietary OS. Don't miss this special offer, valid from December 16th to 23rd while supplies last. Celebrate the holidays with the most trusted name in hardware wallets. Visit ledger.com today. Meet your secure, reliable institutional crypto partner, Kraken Institutional. Whether you're an asset allocator, a trading firm, or high net worth individual, Kraken Institutional unlocks the full suite of tools you and your organization need to trade and manage crypto at scale. But it's more than just powerful products. It's about enabling you to build and grow your crypto practice via deep liquidity, industry-leading security, and white glove service. Think 24/7 support from an award-winning account management team and expert guidance through your institutional crypto journey, from onboarding to product demos and more. Experience it for yourself. Visit kraken.com/institutions and get in touch today. This is not investment advice. Crypto trading involves risk of loss and is offered to U.S. customers through Payward Interactive Inc. View legal disclosures at kraken.com/legal/disclosures. We'll get to that one. Actually, it's funny. I had to explain to Andy Constant the other day. I sent some links to him explaining perps. But I want to get Danny's take on the first two topics that you mentioned there around just the systematic vol stuff and then also the China situation. If you have any thoughts on or color context of what Tyler was talking there.
Yeah, I mean, the thing with the VIX is we had very low realized vol for the last few weeks. Okay, so we were not moving, options were not paying, so we were very, very tight. And the reason we were tight is that dealers were very long gamma, and they were expected to be very long gamma due to that sort of JP Morgan, caller trade that expires at December 31st. And we were sitting around 60-50. We were constantly navigating 60-50 from the top, from the bottom. We couldn't really move away from it. So we were very low realized vol. And you had a dynamic, these are where, things that I pay attention to is the dealer VANA profile. And the dealer VANA profile basically says for a given move in the market, how much vol they need to buy. And this was very large. It was on par with, the August setup, the setup into August. So dealers were set up in a situation where if we had a pop in vol, they have to buy vol. So there's the self-reinforcing dynamic where if the VIX goes from 12 to 18, they have VIX to buy, right? And if they have VIX to buy, that takes 18 to 20 and 20, and as long as the market, keeps selling. So we had some fragility in these dynamics. Again, people just got over their skis with leverage, with positioning and sentiment and animal spirits, So you had also, like I mentioned earlier, the correlation was very, very low. And so just mechanically, if correlation is 5% and it goes to 50%, which is exactly what happened, that is a mechanical flow, a mechanical move that increases the VIX. So that alone will do that. And then you have the dealers who need to buy on any vol spike. So you had all these situations all at once, and all you needed was a match. It could have been anything in particular. I'll go back to China now, and your view there. Equities are sniffing out that they're going to support the economy. I think there's a little bit of confusion from people, especially online, people I respect a lot, that China is going to come in and solve the structural issues that they have. I don't think so. So I think the structural issues are not going to be solved by a dictatorship type of, authoritarian regime that wants to manage the economy so precisely and wants to maintain control of the populace. I don't think they're going to fix the structural issues of completely reorienting the economy to consumption away from industrial production and away from manufacturing. But their language at their sort of, I forget what the terminology of their meeting was, but the language that they had a week ago was very material. It is the first time since, I think, 2008, where the Politburo committee said, we are going to move to a loose policy setting and stimulate the economy. So even though I don't think they solve the big picture, I do think that they will get sequentially better growth next year. And so I think you should be forward-looking, not backward-looking. They don't make those statements very often. Now, what's been frustrating is for people who want to buy FXI or equities in China saying, I want a 20% week like we got in September. Well, you may have to wait a bit, and even myself, I've had, positions in that, and we may have to wait a bit, but it's clear they're going to stimulate. And it's clear that in response to trade wars, they need to stimulate. So it's maybe they're waiting for the clarity on that. before they go. But I think China is going to be a source of growth next year, not a negative. From that standpoint, and that's how I look at those two topics.
How come bond yields haven't like looked forward like the equity market seems to be, but like you'd expect if they are, they said they were going to do a 4% deficit. I think you'd expect like bond yields to rise, and I can't reconcile.
Bonds are not as forward looking as people think, at least not the last few years. If you actually look, I'll just go to the US. If you look at the US, equities have sniffed inflection points when growth, look at August. Equities, typically you get a VAR shock. You'll get a collapse in the market for, various reasons. You'll then get a 50% retracement is mechanical, just from people taking puts off and whatever. And then you usually retest the lows. You don't usually go back to the high and make new highs within just a few weeks in these type of VAR shock events. I study them closely. This is like an expertise of mine. And this time we went like a rocket ship. And then lo and behold, the data started printing better. The equity market tends to be, this cycle at least, forward-looking in sniffing out growth inflection points. And then the bond market, when it sees the data, is then responding, right? So then we got data revisions, and then we got a better payroll report, and then we got CPI reports, and then bonds sell off. In China, what did they tell us? They told us they're going to stimulate more. So that's bond bullish, right? Like if you're going to stimulate more, it's bond bullish. And then when you see data improve, bond bearish. But it's not bond bearish due to imaginary announcements. We need meat and potatoes, and we need to see a response from the economy. Bonds are much more a pure play on the economy than they are about vibes and sentiment and things that equities are. And I think that's confuses people.
So once we get some good data coming through, we'll see Chinese bond yields rise, etc.
You'll see that, and when you see that, it means China's inflation has bottomed. Okay. And so when that happens, that's a game changer, because then you'll start to get clarity that maybe oil demand is a little better. Everyone's very bearish on oil, and maybe there's upside potential if China, I don't think the US is going to like drive oil demand meaningfully one way or the other. Europe remains weak. Other economies are having issues. Canada, as Felix and I know well, is where we sit. But the driver for oil that could change the shift higher would be China. And so I think you'll start to see copper and oil make a more meaningful move if they do turn a corner. And so that's where you would watch to see China bond yields as well as that. But look, Japan had structural problems for decades. There's kind of breaking out of it now in a smaller way. When they would stimulate, you didn't see these big moves in Japanese yields, right? You didn't see that, right? You've only seen JGBs really sell off when it looked like we had a sustainable move in the economy, and that's only in the last year and a half.
That makes sense. That's a good explanation. Okay, so Danny, before we let you go here, I just want to get like a final thought on the rate cutting path or lack of it potentially for next year. So I don't know, the way I'm thinking about this is when I look at the dot plot and the projections for the next 12 months or so, like they've lowered their unemployment rate forecast for 25. Like you said, like we're at 4.25 unrounded. Their 2025 forecast is 4.3. That is a very small bar considering. I think we have a little bit of difference in terms of how strong versus weak we see the labor market. I might see like it being a little more frail than you do. So to me, it feels like the bar for that to repivot towards that direction seems a lot lower than where we're at with core PCE. I do agree that inflation is sticky, but the reacceleration, I'm not fully as convinced, especially with like where the labor market is a lot more rebalanced. Like I'm not quite as concerned about like a wage growth major acceleration. I saw there's an interesting chart from Alec Wallerstein posted this morning that it is starting, but I don't know. I'm trying to think about where their priorities will be. If we obviously January's price for a pause, there's no meeting in February. So really we're thinking about March here. By that time, I just have this feeling, and it's not quantitative in any way, that the labor market the unemployment rate will be higher than their end of year forecast by then. And then they're going to have to decide which side do they want to prioritize. And I sort of feel like they're going to lean towards the labor market, and there's going to end up being more cuts than what's priced right now. I just want to get like your final thoughts here on that dynamic between the two.
They may end up flip-flopping between their two mandates. These mandates may end up in conflict. And so, they may have to do what they just did multiple times. Maybe they are playing 4D chess in a way that I'm not giving them credit. Here's what I'll say. I don't think anyone should be making conclusive, grand forecasts for 2025. I think you should be thinking in scenarios. That's how I think. And I think I can make a case where they cut more than what they put in the dot plot. I can make a case where they don't do anything. And I can make a case where they actually hike. All three are kind of in the ballpark here. I kind of outlined where I think growth has upside. And if growth has upside and tariffs lead to higher inflation, it's possible that they actually turn around and hike, in that situation. We'll have to see how it plays out. Growth needs to show that. The labor market would have to retighten for that to happen. And we'll have to see that. But, could the labor market turn over? Sure. I mean, the arguments for that, I would say the weaker arguments would be, does housing roll over? Does that lead to construction layoffs? Does that lead to manufacturing layoffs? I think housing and manufacturing are at an inflection point, and they've worked through the excesses of the last few years, the inventory overhangs and things of that nature. And it's either now going to have an upswing, which would be goods inflation and really complicate the Fed's path, or it will fall apart and be like the cyclical argument, that we're heading towards a slowdown. I'll just kind of talk about labor. There's a lot of comments out there that I see from people. Well, when they pivoted, we were at the same unemployment rate as we are now. So the Fed should be more dovish, not less dovish. This is incorrect, and I'll explain. When they pivoted, it was a sharp rise of the unemployment rate for 0.2% in a single month. Okay. And obviously they didn't have the revised data at the time, to say that, it was hurricanes and it was immigration that has been the story. But since then, we've had 4 months of payroll reports, and it has not worsened. We have not seen more layoffs, right? And so when you look at the situation, what do we have? We have a 4.25 unemployment rate, but layoffs are not picking up. And what they want to see is demand for labor pick up a little bit. They don't want it to overheat, but they want to see it pick up a little bit. And they think that 100 bips of cuts, which takes time to work through into the system, will be enough potentially. Maybe they need to do a little more, but that should be enough. But I think, and you had on your forward guided show, Joseph Wang, who I respect a lot, and he had a comment that I kind of want to discuss. And I think this is an important, part here. People have misunderstood positive supply shocks. So a negative supply shock is something we're all familiar with. Imagine Iran gets attacked in some military thing, and 3 million barrels of oil are taken off the market, and oil spikes $20. And that is the only reason inflation goes higher. The Fed is supposed to look through this, right? Because it's temporary, it's going to come back down. But people do not apply the same logic to positive supply shocks, and they're making a mistake. So let's just go, what do I mean by that? Let's just say you take 3 million people and throw them into the labor market in one shot, like the aliens that are flying around New Jersey. If they decided, hey, I want to come work in the United States, and we threw them in, it takes time for them to get jobs. It takes time for them to get settled and acclimated into an economy, okay? So the unemployment rate will go up because the supply is increased, and it takes time for demand to match that supply. As a mechanical move, the unemployment rate moves up. However, at some point they'll get jobs. And as long as you're not deeply restrictive, the way the Fed kind of characterizes it, contracting growth, they'll get jobs. So we have a 4.2% unemployment rate with a 3% GDP, and we get a positive supply shock. A positive supply shock is disinflationary. But just like a negative supply shock is only temporarily inflationary, a positive supply shock is only temporarily disinflationary. What a positive supply shock does is raises the potential GDP. So, for example, let's just say we were 3% real GDP, 3% inflation, and you get a productivity boom. It might make the calculus 4% real GDP, 2% inflation. Now, people who are only looking at inflation will say we should cut rates 100 bips. That would be an enormous mistake because nominal GDP hasn't changed, still 6 in this example. And you've actually raised the productive capacity of the economy. So if you cut too much, you'll actually end up with a very quickly an overheat situation. And so I think people have not understood the positive supply shock angle here. So do I think demand has an upswing or downswing? And what does that mean for labor? I think number one, they cut 100 bips. Number two, the election. The uncertainty around the election is passed. For 3 to 4 months, if you were a small business in particular, you had no clue if you were getting tax hikes or tax cuts. You had no clue if deregulation was coming that would make borrowing more feasible. And you also didn't know about tariffs. You have all of these things that were uncertain. We got that clarity, and now we get optimism in the economy. The main channel for me of growth is lending. And Jamie Dimon was on TV, right after the election, and he said, it used to be for $100 of deposits, we did $100 of loans. Now we do $65 of loans because of all the regulations. So they're clamoring. They're like, they're like foaming at the mouth for this change to they can get back to lending, which is what they do, banks. And that to me is the upside. And I think we will see a sub 4% unemployment rate at some point next year. As immigration is slowed, so
Right.
that supply is done, and it's going to zero, and if potentially negative, you're going to then get the pro-growth, agenda here. And so, to me, my framework went from financial conditions loop to 1998.
Interesting.
My framework is now 1998.
Two maybe just you triggered thoughts that I've been having, and they're some related, some not, is one around how I've seen some talk around how the Fed maybe purposefully or unpurposefully set themselves up for the labor market to potentially quote unquote disappoint, right? Because we're very close to what their 2025 year end mark is, which I think on that side of the equation is probably fairly accurate because we know they want to support growth. But I also just remind people that every metric going into this meeting said they shouldn't cut based on their expectations from September. They were over inflation, under unemployment rate, over growth, and they cut. So like you said, I don't even think they know what they want to think in a couple months. And the other one on the positive supply shock is because Tyler, you always talk about the global peace dividend. I carry a slight, because I'm optimistic on growth. I don't think we go into a traditional recession, even if the market kind of has some of these hiccups. I think, I don't know if every developed country is spending 6% deficits. I just don't know how you get a nominal recession. So that's like net this or at least puts a floor on commodities and base demand. But the one thing that I do think about, I would say on the oil front, this would be actually very bullish liquidity and risk assets is the global peace dividend. If Trump really does solve Russia, if he gets more ceasefires in the Middle East, and the big one, Saudi, Bessent's 333 policy of getting oil prices down to be able to appropriately handle the debt burden and steepen the yield curve. Like it seems like there's a lot of wiggle room in coming to negotiations, and right, he wants to maybe please domestic oil companies as well, but with fair prices. But I'm against the very bearish oil crowd because I skew on the side of solid growth. But that would be the thing that keeps me up at night is like Bessent is an absolute genius. Like, I mean, he's very, very strong markets practitioner and knows how this stuff works. And he's not going to want $100 oil price to be able to facilitate what he needs to do.
The Treasury Secretary is getting these. First of all, I think Bessent is excellent, but he's getting these magical properties assigned to him that are just not part of his mandate. That's not his job. He's not the architect of the economy. He doesn't direct policy. He has an input into these things, but he cannot listen. The 333. I'm very pessimistic, or I would say skeptical of the 333. You're not getting a budget deficit to 3%. First of all, they're not even talking about that amount of cuts. And there is not really that much room in discretionary spending to cut to get you there anyway. So unless you're doing entitlement reform, you're not getting there. Or cutting defense spending, which is just not going to happen. In fact, it'll increase, in my opinion.
Well, they're saying pre-interest, though, on the debt, that 3 is.
Yeah, the primary deficit. Yeah. I get it. But look, that would be a very big negative to growth, and that's counter to the Trump, agenda. So I'm skeptical of this. But either way, by the way, Bessent himself said by 2028. It's a 4-year project, and we'll see how they get there. 3 million barrels of oil, I would say you cannot demand and make energy companies change their discipline, which their discipline is not to increase. Their already production is peaked. And their discipline is not to do that. Where I think the potential downside to oil comes from is Saudis. You'll get offsetting from potentially Iran being taken care of geopolitically. I think that's very high likelihood. But that'll reduce supply. But then the Saudis can come in and more than compensate for that by increasing supply if they want to, if they get some sort of deal with Trump. So I think more oil is capped at a level like 75, then I think that it's down. But I don't have high conviction on oil. The thing that I think people need to focus on is, again, 1998 is my paradigm shift. And, I can go through that if you guys, want to, but, that's where I think people need to understand that the dynamics of the last couple of years are gone and it's changed. And I think 1998 is my framework, how I look at it.
That's the Asian financial crisis sucking sound into U.S. asset markets.
So in some ways, yes. I mean, look, you had 2 adjustment cuts in the 90s. In 95, they cut 3 times, but the unemployment rate was 5.3%. So you had slack in the economy that you could cut without creating inflationary pressures, right? And it did. It worked. It worked really well. They ended up reversing 1 cut, which is no big deal. The 98 cuts were in response to a growth scare and a VAR shock. That's exactly what we had in August, but they cut at a 4.5% unemployment rate. And when you cut at a 4.5% unemployment rate, you run the risk of overheat. And what ended up happening is the markets, which had already been in a raging bull market, went parabolic from there. And you had mania in risk assets, which eventually turned into a bubble. And so you had a 50% rise from those 3 cuts that they did at 98 over the next 18 months, after already running up something like 70%, which is exactly what we've just done. And so, why I'm actually, I was very pessimistic about the Fed coming into Wednesday, and why I think the Fed, I don't know if they know this or not, but the biggest concern is that for me about the economy is that they overstimulate, markets turn into a bubble at the same time you have a optimism in the economy that we haven't had. And then you have to slam the brakes down the line. So that's where I think the correlation between bonds and stocks has flipped. If stocks are going to keep dipping, bond yields have to be higher to keep financial conditions moderately expansive, not, just like explosively expansive. Because if you overdo it, you get in 98, before long, the unemployment rate went sub 4% and CPI went up 2 full points. And then the Fed reversed the 3 cuts and hiked another 5, 200 bips reversal. 10-year went to 6.5, and then we got a recession and had to go to 0. So my concern is my downside risk to the economy is from that. Is
Let me-
not.
Let me ask you this. The productive capacity for our economy is like 10x what it was. We're putting, there's spaceships that could economically get into space. Like we can, SpaceX has a $350 billion valuation. I have to mention Rocket Labs because it just doesn't go down. I don't own it, but I have to mention Rocket. We can do, like, relatively, I just have to say, we can find oil really easily and dig it up. If there's like, and so I'm a fader of, like, not only that, but then, dude, I had to write a recommendation letter for my nanny's son the other day, and I was like dreading it. And I put it into ChatGPT, and I was like, here's his name, write a great recommendation letter. He's awesome. Came out, 30 seconds, recommendation letter. I'm like, wow. Like, how productive are these things now? Where I love the analogs, like it's psychologically great, but I'm kind of wondering, like, are we at some sort of first turning industrial revolution of productive capacity where like we don't have to worry about the inflation like we used to?
The 1990s had that exact same dynamic, right? We had a productivity boom. That's why I'm focused on the 1990s as the parallel here. We had the productivity boom, and they cut rates into that in a growth scare and a VAR shock, and that is potentially leads to an overheat. So we have a productivity. I wouldn't say boom. Productivity was like 4% in the 90s. We have productivity boost back to what I think is a better profile. There's a lot of debate on whether it's sustainable or not. I think it is. We have a productivity boost at the time of a huge labor supply positive shock. And so the capacity of the economy has gone up, but we are still growing above capacity. Nominal GDP above 4% is technically above capacity. And we've been growing 5 to 6 for 2 years.
So you're saying you like small caps?
I'm saying I do like small caps. I'm wary of first 1 to 2 months of the year.
Then
But
I think that's fair.
I'll just see your balls.
No,
yeah,
look,
Danny,
I'm very pro the economy. I am actually bullish the economy, that I think we have a leg up. And not very many people think that. People think we might chug along at the same pace. I think we have upside to the economy from the Trump agenda, and I think people are still not pricing that in fully.
Yeah. Man, Danny, we said we were gonna have you for half an hour. That somehow turned into an hour. Is that good? But it was awesome to have you on. Very, very interesting to hear the breakdown.
Thanks for dealing with us hooligans.
Stop
go up. Stop go up.
Have a good weekend, guys.
Yeah, thanks, Danny. Appreciate you jumping on.
Take care, Danny.
Take care.
See you guys.
All right, what should we talk shit about now? No, just kidding.
We're still going. Okay.
Oh, we're still going just for a few minutes. I want to note, but I did want to talk about we're at the end of the year here. We're not going to record next week. We're on holidays, so I just wanted to have like a final wrap up of our thoughts going into end of year. We could also talk a touch about our views on crypto, and just end it there, and maybe pat ourselves on the back for a hot minute if we want to as well. But we can also not do that.
My take is, I think Danny said it well, right? We're going into a low liquidity tape. Things might have, maybe we bounce right back from this. Maybe we just chop here because no one sticks their neck out pre-year end. I don't have great views, but I do think that there's the probably my strongest view, and it's probably not around timing necessarily, but that there is this big divergence between, I kind of believe in the Bessent ability, right? I believe Yellen, at least since I've been following the markets, seems to be the most heavy-handed, centralized, manipulating force I've ever seen out of the Treasury. I don't remember Mnuchin being like this and previous Treasury secretaries. I mean, the way they've manipulated the RRP, the BTFP, all these, Treasury issuance is just actually incredible. So that almost gives a green light to future, it sets new precedent. They never give back power. They just keep accumulating more. So I'm kind of optimistic that like I'm a fader of I think yields should be higher, but I think yields in every fiat currency should be higher because they're deflating that. I think there's a higher cost to owning dollars in a world where they're entrenching inflation in a way. But I don't think it's, when we get these blowouts, it's going to be violent. But I don't, if it's a stair step up in yields like a 2020 environment, 2021 environment, I think it can still be very positive as long as it's on the back of growth. So for the reasons I mentioned earlier, I do like the quote unquote Trump trades from here. They've all reversed practically their post election gains and rallies in many assets, not Bitcoin. But I think there's going to be a setup, whether it's now or in 2 weeks, to play that going into Q1. And, again, I don't have crazy conviction if that means the whole market up, because the market is just Mag 7 at this point. So maybe we just chop more and it's just more rotational. But I don't think it's a time to get like crazily bearish, right? The Fed is still going to backstop growth, maybe not as much. So maybe steady state of multiples should be 5% lower from here, which is fine. But like, I don't think the economy is going to fall into recession. And I kind of think they want to steepen the yield curve. And I do believe that bank lending is really stimulative when you have profitable, regional banking margins. And globally, I'm looking for China to get the stimulus to stick. And I'm looking for that to be another sort of, if it's not just the US growing, which we've had for the last 2 years, right? That's can be kind of reflexive. And, that also is very positive for liquidity because it allows people to seek assets elsewhere and not just demand dollars and start deploying capital into other avenues. So super long-winded way, but I think there's going to be a lot of opportunities, and people are going to want to in 2025 think more about sectors, theses, single names, single industries than just the Mag 7 index up only type of thing.
I mean, you heard me before. I'm generally more constructive. I think we got a little cleansing, vol shock there, similar to when we did in the yen carry trade, where all the quant stuff goes haywire. Here's a couple of things where it will change my tune longer term. If HYG breaks, it looks like we're holding here on HYG 250 day and 200 day moving average. So essentially, like, credit spreads are going lower today after spiking a bit. If that stays, and then I'm also seeing SMH semis, which have led us, that bounced off to 200 day, and Bitcoin's bounced off, the 50 day. If any of those really break lower, I'll start looking for the zombies in the market for, a sign something's going on. I think in China or emerging markets where dollar liquidity is drying up and you have a global margin call and debt. But the end game is clear. Like, I think we're in this Michael Howell soft patch of global liquidity, and they're going to have to turn on the spigots longer term. In China, that's been a big negative to global liquidity. They're going to have to do it everywhere just to keep the debts are so huge. I'm so bearish. I'm bullish. That's the bottom line. Is I think they just have to keep the money turning over in the system so that the interest rate, payment, the interest debt cost is serviceable by the liquidity sloshing around in the system. It's a giant refinancing mechanism. And I think as long as that's going and you have, growth good and productivity good and inflation bad, then markets will go up. But,
Market up.
Yeah.
market up, stock down, stock up. So I don't know. I'm also really, I think we hit an extreme in sentiment as well. You saw a lot of those charts.
Agreed. Yeah.
People got absolutely stuffed in a locker this last 2 weeks, and I'm sorry if you did. It's hard. I think a lot of it, especially in crypto, was the options market opened up in that dynamic of people buying calls, and they don't realize how far implied volatility is from realized volatility. So you're buying really expensive upside insurance. I think that phenomenon is now going to be clear here after this week, and we'll be in a low liquidity holiday season where realized vol is low, and we're going to see implied volatility bleed. So generally more constructive, long way of saying, change my tune if some of those things happen in the credit markets.
Yeah. Yeah, I mostly feel the same. I feel like maybe a little bit more choppy from here until like mid-Jan is sort of my framework, but yeah, roughly speaking. Well, should probably leave it at that. But yeah, ton of fun to have Danny on. Great to hear everybody's end of your thoughts, and yeah, we'll pick it up in the new year.
Awesome.
Sounds good.
Good stuff.
Thanks,
See you guys.
Yeah,
Happy holidays. Merry Christmas. Happy Kwanzaa.
all that good stuff. Looking for a blockchain that combines high performance with zero headaches? Scale is your answer. With its advanced parallel processing and modular sharding, Scale delivers gas-free transactions and limitless scalability, perfect for gaming, AI, and consumer-facing dApps. Already a top 10 blockchain on dApp radar, Scale is powering next-gen use cases with over 750 million transactions and counting. Discover the future of Web3 at skale.space/ecosystem and stay up to date with their journey on X at Scale Network.